Hi, my name is Rans, and today we are going to do a basic financial analysis of a very hot company in a very hot sector, which has been rallying a lot recently. Yes, the pharma and the chemical sector, and we're going to look at a company in that. But before we start, please remember this is not investment advice. We're just trying to understand the financial performance and position of the company. All right, let's get started. The company that I'm talking about is Divis Lab, right? It is a generic and custom API manufacturer, right? In fact, it is one of the largest in India, and it also holds a 70% global market share in the painkiller API. So, in truly, it is a company that is making in India for the world, right? So, that is a very big thing. Okay, let's quickly start with the financials of the company and then we'll come later to the highlights. If you look at revenue, EBIT, and PAT, I mean, those have grown at a very, very strong rate in the initial 5 to 6 years here, right? But the last 4 years haven't been the best because if you remove FY19, then the remaining 3 years here haven't been the best for the company. But even if you look at overall, the revenue has increased by 17% CAGR, the EBIT slightly lower 15.5% CAGR, and PAT again slightly lower at 13.8% CAGR, right? So it would be a sign that the margins are slightly decreasing. This is something we'll come back to later. But even with the comparatively poor growth in 3 out of the 4 recent years, the company still has, over a 10-year period, it has still grown very, very well, right? I mean, 17% CAGR is a lot, and it's up 4.1 times, 3.7 times, 3.2 times here, right? All right. So this was about the main profit and loss items. Coming to the cash flow items, which is cash flow from operations, investing, and financing. So with cash flow from operating activities, it has been lower than the PAT in most of the cases, right? The cumulative CFO is about 1300 CR lower than the PAT. So this is something that needs to be looked at in a deeper way. And if you also compare the CFO to PAT's ratio, the cash conversion of the company, in the initial years, in the 4 years here, it was not so good, but it has started to improve. So in these 4 years, it was very solid. Then it again fell, and it is again, started to rise. So my understanding here is that the cash conversion of the company is improving, definitely, but it still is not up to the level of profit. So this is something that remains to be seen with respect to the company. All right. With cash flow from investing activities, the company has continuously reinvested into its assets, into its fixed assets. As you can see, most of the transactions here relate to reinvestment of fixed assets. There are some net investment transactions as well when the company, has additional cash which it doesn't have to use, and it, places them on temporary deposits or something like that. And if you look at here, the company has been on a sort of a long-term expansion plan, which has been going on as per the company's website also from FY16 till now. And even if you look at FY15, it was a major amount here. And in these 4 years, in these 5 years, actually, I feel that there's a long-term capex plan being going on, because usually with companies in this industry, they don't, they don't come up with the facility very quickly, right? The capex is spread out over a number of years, and this is what seems to be happening with this company as well. And I would assume it to be, expanding into new sort of product lines, or custom synthesis as well, right? So that is why the company is growing. Cash flow from financing activities, most of this actually relates to the payment of dividends. I mean, there is an anomaly here, which is something that we'll figure out, but mostly it is related to, most of the cash flow from financing is actually related to dividend payments. The company has regularly been paying dividends, and so that is a good sign as well. Now, right now, coming to the balance sheet items. So if you look at equities, equity has gone up. The growth in equity has more or less been in line with the growth in revenue, right? It's a very steady growth, so to speak. This is something that you would expect. Now, comparing equity with non-current liabilities, the non-current liabilities figure has been very small and insignificant, so to speak. There were probably some borrowings here, and then there are higher figures here as well. But the interesting thing to see here is that these are not borrowings, right? If you look at the amounts here, these non-current liabilities are not borrowings, these are provisions. So the company has made significant amount of provisions here as well, right, which would also explain slight dip in the profitability as well. But we need to understand that what is the, the rationale behind, creating these provisions, and this is something that we need to research deeper. But yeah, borrowings are not the main liability item, provisions are, right? So the increase in non-current assets we've already talked about, and in fact, if you compare the cash flow from investing, the cash outflow from investing versus the non-current assets, you'd figure out, yeah, that the company is more or less been growing, and there have been some small other changes in other non-current assets as well, but mostly it's been, the fixed assets, the reinvestments into fixed assets, right? Talking about the current assets and current liabilities, again, the growth has broadly been in line with revenue growth, slightly lower than that. With current liabilities also, it has been that way only, but there is again a sharp increase here of about 1,000 crores here. And again, I looked at here, so those are short-term provisions. So this is something that we need to understand, that is it a temporary accounting thing here, or if there's something other going on, right? And if you also look at the net working capital, or the current assets less current liabilities, it's, I mean, the company has maintained a very strong or very decent working capital, and the growth in that is slightly lower than the growth in revenue. So you'd expect that the company is efficiently utilizing its working capital as well. All right, now coming on to, we'll just quickly once again go through the growth of high level financials. Very solid here, right? 2 or 3 years out of the 4 years here. Very easy and very consistent growth in equity. Cash flow has been slightly volatile, which is understandable, but the cash conversion is improving, which is the important thing. Very smooth sailing here in equity, consistent reinvestment into assets, except for the 1 year here, right? Net working capital has also been going in line, but it has slightly decreased in the couple of years. In this year, it's probably due to the high increase in current liabilities. Liabilities, the amounts of growth here look very large. The percentages of growth here look very large, but it's because it's on a small base, right? And so even a small increase there might result into a higher percentage change, right? But overall, liabilities as a part of balance sheet are not very significant, to be honest. Now, coming to the metrics of the company, and if you look at the metrics, I mean, you'll find the company has been producing staggering returns on capital and returns on equity as well. In fact, again, if you look at the 6 years here, it was very solid. In the recent 3 to 4 years, it's not been that good, right? It's for the first time actually here it fell below 20%, and here it actually fell below even 15%, but it has quickly recovered, and this is something that we'll have to understand, that how does this go forward, right? Because the company is also in the midst of an expansion plan going on right now. Right. So as we saw that the growth in PAT was lower than the growth in EBIT, and that was lower than the growth in revenue. So if you look at here, then, in the recent years, the margins have also, slightly on the lower end of the spectrum. But still, I mean, they have been operating in sort of a range here. So within an 8 percentage point range here, and within a 10 percentage point range here. And this 1 year, which was an anomaly, which was where the growth was also negative. So this was probably not the strongest year for the company. But apart from that, so if you remove this year, then the EBIT and PAT margins have been operating in a very specific range. And I think, I mean, you might expect the company to still continue operating its margins on this range, right? And these are very high margins, although these have slightly declined, but still these are very high margins, right? And the story with capital and asset turnover has also been similar. It's been operating in a range. It has increased and it has fallen as well, but broadly it is operating in a range. And if you look at the FY11 capital and asset turnover and FY20 capital and asset turnover, they've broadly been the same here as well. The maximum, it went up to 0.86. It fell down also to 0.51 here. The capital turnover, maximum asset turnover 0.77 and minimum 0.47, right? And the company is again going through expansion. So you might expect this sort of trend to continue because of the nature of the company, the nature of the industry as well, right? Talking about the liquidity and solvency position, the asset by equity. So this is very comfortable. The maximum it has ever been is 1.46. So the company, the liabilities are the smaller part of the balance sheet, so to speak. Because, for example, here, if you have 1.29 rupees worth of assets, 1 rupees worth of that has been financed by equity, and only 0.29 has been financed by liabilities, not just non-current liabilities, but all liabilities, right? Cash conversion we've talked about, not the best in the initial 4 years, but slightly improving here, and let's see how it goes further. The net cash flow figure, this is something we come back to later as well. But first, let's talk about the current assets and current liabilities. I mean, going more or less in line with revenue, how the revenue is growing. I mean, slightly more volatile, so to speak, with respect to that, right? Non-current liabilities to equity, very insignificant, as you've seen, right? I mean, right now it's just 0.04%, sorry, 4% of the equity value here, right here. So, I mean, from a solvency perspective, the company has very strong position. Right. Now, coming to this net cash flow part here as well, right? So you saw that the company was making continuous reinvestments into its assets, and it was also paying out dividends. So my understanding here is that the company is generating enough cash flow to pay out dividends, and also to keep reinvesting into its business, into its assets, because the company hasn't raised much of external capital as well. So that is a very, very healthy sign for any company. It is generating good returns on capital. It is reinvesting a lot of the returns that is generating, and it is paying out some dividends as well. Right. Now, coming to the highlights of the company, we'll quickly wrap up. Very strong EBIT, revenue and PAT growth in earlier 5 years, but slightly poorer in recent 4 years. And the PAT growth has been lower than EBIT growth, which has been lower than the revenue growth as well. And it will be interesting to see if this can turn around, or if this can improve. CFO by PAT as 85% is in 5 out of the last 10 years. The cumulative CFO is about 1,000 crores less than a cumulative PAT. 1,300 crores less than the cumulative PAT, but the cash conversion has broadly been improving in the recent 6 to 7 years, right? CFI, cash flow from investing, is mostly asset reinvestments, and cash flow from financing is mostly dividend payments, right? As we've talked about, equity has gone up in line with revenue. This is something that we saw. And negligible debt, I mean, nearly no debt. There are some short-term borrowings, but that is okay. Provision is a major liability item. So this is something that, if you're going to look into the company further, do look for that. Why has the company made this provision? What is the rationale behind creating the provision, right? Increase in fixed assets slightly higher than that in revenue. So if you look at the increase in fixed assets here, it's about 5.2x, and increase in revenue is about 4.1x, right? So I mean, that's slightly higher, but you could also understand the fact that the company is going through a major reinvestment here, right, in the last 4 to 5 to 6 years as well. So, and the because of the nature of the industry, you make reinvestments in particular years, and the return from those reinvestments, or the utilization of those reinvestments, only improve a couple of years down the line. So the gestation period is naturally longer, right? All right. Return on capital greater than 20% in 8 out of the last 10 years. Return on equity greater than 20% in 6 out of the last 10 years. Both of these have been on the lower side in the recent 4 years, so to speak. But this is something that you can reasonably expect to improve going forward. Margins have broadly been maintained in a healthy range, with a slight decrease in recent years. It's more or less the same story as with the return on capital ratios. Capital and asset turnover have broadly been stable, so that is something commendable on part of the company, right? Because of reinvestments going on, and also maintaining revenue. So this seems like a good sign. And as I talked about earlier, I feel that the company is generating enough cash, to reinvest and pay out dividends as well. So here is the cash flow from operations, and if you look at the total of cash flow from operations, cash flow from investing, and cash flow from financing, the sum here is about a positive 65 crores, right? So the company is able to, invest. It was also able to grow. It is in the midst of a major investment plan, and the company hasn't raised any external capital as well. So while paying out dividends, so this does seem like a good performance on part of the company. And even if it did take a lot of so to speak debt here, right, then it has repaid it. So it's very comfortable on that side. All right. So what is the conclusion? The conclusion is that the company has had a very strong financial performance. It still has a very strong financial position. It has been struggling for growth in the recent 4 years, but I think it is poised for growth recovery. And if you also look at the trailing 12-month figures, or if you looked at the half yearly figures for FY21, then those look very, very promising. And during this time, due to all the attention that the health sector as large at large is receiving, so the company is looks set to be a beneficiary of that, right? So that is all that I had to share about this company. I hope you find this interesting. It's one of those companies which is lesser known as part of the Nifty, but it has been, performing very well, and it is doing extremely, extremely well in its industry, and also is a global leader in one of the painkiller APIs. So that's a very big thing for an Indian company, right? If you found this video helpful, then please share it. If you have any feedbacks or wish to discuss anything, you can comment below. The worksheet, the link to the worksheet is available in the description. The sign up link is also available in the description. And thank you so much for watching. I'll see you again with another company.